rising rate environment. The U.S. Federal Reserve has been active moving rates higher. And as a matter of fact, in the U.S. and in the global markets, the long part of the yield curve has been rising also. So with a floating rate asset class, which has no material duration risk in that particular instrument, the performance has really been almost exclusively a function of rising rates, increasing coupons in our asset class, and no material decline in price because of the lack of duration. I would also say we have seen a relatively benign credit market. So even though default activity is not absent, it hasn't been widely dispersed or systematic. It's been more idiosyncratic to issuers or individual industry sectors. So it's been a relatively constructive environment to invest in below investment grade credit. But the biggest lift has really been due to rising rates. And we expect that to continue. And as a result, we expect the performance to be quite good for the balance of the year into 2019. Too generous? I would say no. We like to get paid for the risk that we're taking. But it is a supply and demand driven market. And in a rising rate environment, of course, demand for floating rate loans continues to be good. The new issue supply of loans coming to market that we invest in is not always consistent. At times it can be up, at times it can be down. So you will see in certain periods a mismatch between supply and demand. And whenever it's a situation when there is excess demand over supply, it becomes more of an issuer's market, just like in the bond market. And that's when you will see pricing on loans come down, obviously being more of an issuer's market, and some of the terms and conditions that are basically supporting the loan document will become a little bit more aggressive. And that's the case we're in today, where some of the traditional protections that lenders would receive don't exist in some cases. Covenant light is the case in point. It doesn't at all, from my perspective, and I think most loan managers would agree, it doesn't change the investment thesis. In a relatively benign credit environment, those issues don't come into play per se. And if you have an active manager who's actively managing the portfolio to avoid losses and default activity, you can have a very good outcome, even though terms and conditions have become a little bit more aggressive. So all in all, it's a bit of an aggressive market these days. Pricing is still good on loans. Loans are still delivering excess risk premium, a spread over LIBOR. That's much more attractive on a relative basis than what you're seeing in, for instance, the US or European high-yield bond markets. The balance of the year, 2018, looks quite good. If we just assume that there's no external macro volatility that picks up that's systemic and sustained, the senior loan market should close out the year at the high end of our original total return expectations. It's already tracking to the high end of that expectation as it is. So just assuming we get the rest of the year in interest carry and no material change in prices, meaning a stable overall macro risk environment, it's going to be a very good year for the market. And of course, we're still expecting the Federal Reserve to increase rates at least one, if not two more times in 2018, which will be another tailwind to loan returns. 2019 will be a story of whether or not those conditions continue or persist. As long as we don't see a material decline in overall economic activity in the US, meaning GDP stays relatively stable, if not continuing to grow at relatively robust levels, then I would expect credit conditions to stay quite constructive, meaning defaults stay low. And if the Federal Reserve continues to follow its prescriptive or advertised course, which is anywhere between 2 and 4 more rate increases, I can almost assure investors that the loan asset class will do exceptionally well, both on an absolute basis and relative to traditional fixed income.